A beginner deposits $50, then $100, and in a single day, maybe even a single trade, boom, the account is blown. The trader sits down looking sad, asking themselves what they could have done wrong. But the truth is, most traders don't blow their accounts because of the market. They blow their accounts because of themselves. And today, we're diving deep into the 6 psychology, mistakes, toxic habits, and emotional traps that destroy traders long before the market does. 1. Trading for fast money. You see, most people come into Forex looking for a rescue, a quick escape, fast cash, a shortcut, or a miracle. Forex becomes plan A, B, and C. Instead of approaching trading like a skill, they approach it like a lottery. They want $10 to become $100, $100 to become $500, $500 to become $5,000. And because they expect the impossible, they risk the impossible. High lot sizes, no stop loss, emotional entries. The market doesn't punish bad luck, it punishes bad decisions. Next, we have the silent account killer, revenge trading. It happens in that really dangerous moment right after you take a big loss. Your logical brain shuts down completely and pure emotion takes over. You're not trading the chart anymore. You're trading your own feelings of anger and frustration. And this is the voice that does all the damage. I can win it all back just one good trade. It feels like a confident plan, but let's be real. It's pure panic. You start chasing that loss, doubling your risk, and before you know it, what was a manageable loss has turned into a total catastrophe. 3. Trading without risk management. Here's the thing. Losing is not the problem. Everyone takes losses. The problem is losing too much. Most beginners almost always ignore risk management. They jump into trades without a stop loss to protect them. They have no rules on how much to risk per trade, no plan when to exit the trade. They're just flying blind. Trading without risk management is like driving a car without brakes. You might get away with it for a while, but eventually you're going to make one mistake and they will be absolutely nothing to stop you from total wipeout. Another huge failure in trading is not understanding market structure. Most beginners know the patterns, they know indicators, they know entry signals, but they have no idea what the higher time frame is saying, why price is moving, where liquidity is found, how sessions affect movement. Without this knowledge, every entry is a guess, and guessing is gambling. A trader without market structure is like a traveler without a map. 5. Copying other people's trades. Blindly copying signals from some guru online sounds easy until you realize there is so much you don't know. You don't know their account size. You don't know their risk tolerance. You don't know their psychology. And to make it worse, some of these so-called signal providers don't even show you how they got the signal. No chart breakdown, no analysis, just a quick buy now or sell now. You're following their plan with your money, but you can't copy their discipline. And that combination is a recipe for disaster. And finally, the mistake no one wants to talk about because it involves actual work. Not keeping a trading journal. Without reviewing your trades, analyzing what went wrong and tracking your progress, you can't improve. It's impossible. You're literally just stuck in a loop, making the same costly mistakes over and over again. So when you put all this together, what's the path forward? Well, it's about shifting your entire focus away from making money and towards fixing yourself by building discipline. Understand this. The market is a totally impartial judge. It will relentlessly punish impulsiveness, greed, and ego, but it consistently rewards patience, discipline, and having a solid system. The choice of which side of the scale you want to be on, that's entirely up to you, because the market will only start to respect you when you finally learn to respect it. Thank you for watching. Don't forget to like and subscribe. See you in the next video.